Okay, so now we made our stock list in this sector, in the integrated oil sector. Now what to do? We all, I mean, most of you know the state modeling. So I mean, okay, before we jump to that, like we all agree that we need to keep our focus on the large market share companies, and we also want the stock where the price keeps moving, right? Either wrong or right. If I think it's going to move, it has to move, because if it moves in the wrong direction, I can agree that I am wrong, move on, and if it is right, I can make profit and move on, right? If it is sitting still, for option traders, we are losing money. It's a depreciating asset anyway, right? If it doesn't move, if it's sitting stand still, then we lose money too. We don't make money. So in the state modeling, I mean, if the current state is state 1, is the price low? May or may not be, right? Because it's a small line, big line. If I draw a bigger line against the current line, and the bigger line, I mean the current line will become smaller in relation to the big line, right? And so it's all, price is a relative value. There is no way to tell like what is the real value price. Though even though I mean, like how I shown the analysis, we can do a discounted cash flow model, value-based analysis, and all. We can do that. But if you do that, you are doing investment. You are not trading. That's not a trading model. That's an investment model. The value analysis is basically the investment model, not for trading. So for state modeling is designed not for investment. It is primarily for trading. So a swing trading type, anywhere between like a week to two months is what the time frame we targeted. So if I'm in state 1, if I enter into state 1 today, today's price could be lower or could be higher. We don't know, right? So, but whereas if you go to state 8, it is the most bearish state, right? It is the most bearish state. So by the time you get to the state 8, you have to have the state move to state 2 already. All of you are watching the state modeling, how it's moving. So initially, like when the pretty strong stock goes to bearish state, it goes to state 2. Then it goes to state 4. Gradually goes down, right? And may go to state 6. It may jump directly from 4 to 8, but usually like that path 2, 4, 8 is the path. So by the time it goes to 8, that means the price has already fallen, like, because it's already bearish, increasing, right? And so we created a model, I mean, we created a button which is not available yet for you, but tomorrow it will be available. Yeah, another button, ILO. Intelligent law. Yeah, in the Delphian, not in studies, in the Delphian section of the custom screener. Yeah. See, that's a difference between the hardware business versus software business. We can create a button like, yeah. Okay. So ILO, there are 4 types of ILO. One could be a low price, meaning like what I think low price is. When in the state modeling, when we go to state 8, we know it's a low price. Is it low enough or not? We don't know yet at this point, but we know that it's a low price.
Relatively low.
Relatively to. Correct. Yeah, correct. That's correct. Related to the past time frame, the recent time frame, it's lower price. That's what state 8 modeling says. Okay, so one is low price. The other one is, what if I add a lower Bollinger Band? If the price has taken, now we are combining the technicals. Now we are combining the technicals. We saw Hess fundamentally not good stock. It's not doing good. We saw ExxonMobil still making $20 billion profit, even with this oil price. Fundamentally good stock, right? So, and the free cash flow is there. So fundamentally Exxon, like now I want to buy Exxon, but I want to buy Exxon at a lowest price.
Buy now.
Okay, so the model one is I use exclusively state 8, believe in it, state 8, as soon as it hits, I know it's the lowest price, I buy it because it may go back up again. All right, that's one point. And if I add Bollinger Bands, and if the price has shaken up, like back in 2018, what happened? October, market crash. When the market crash, all stocks fall. But the point is, there is an expected standard deviation move, expected volatility. But all stocks will not fall at the same speed, right?
High growth stocks fall the fastest.
Right. So the high growth has more volatility and they fall fast. And when the speed of falling is much more faster than they should be falling, that's what the Bollinger Band is telling you. If it is falling faster than what it should be, then it will straight go back up again. What happened to the market 5 days back? Fallen 600 points, went back. A systemic fall of 100-point 5-day drops, it will recover, it will take longer time to recover, rather than a 1-day drop of 600 points can be recovered fast. Got it?
Yes.
So they see it as a buying opportunity, that 1-day fall, and then there is more buying activity coming in. So when the Bollinger Band, when the lower Bollinger Band comes back, hits it, and when and it has fallen too fast and a lot, then the stock usually rebounds back. The stock goes back. That's why I'm calling rebound. Okay. So another one is like okay. This is a simple example. If we enter into the state modeling 8 at a $100 price, and we are our target is about $90, and we hit the target $90, and the reversal is saying, and we hit the target as 90 and we went to 80, but then 80 has to cross 90 above and then start coming back when it's coming back up, right? So that's what I call it reversal. We'll again take a deeper look into each of the model lines. Okay, so I just want to introduce that way, like your mind is open. Then like next when we go and see example, we'll see the exact one, and you'll get these slides too. That's called reversal. Wait for the reversal model. This one is trending upwards, is basically this is exactly the uptrend, the state 1. The relative price could be low, right? If the state modeling is saying state 1, what does it mean? It is the most bullish state. For whatever reason it accounted for. The algorithm is saying like it could go higher. Right? So since it could go higher, then that I'm calling it as an uptrend, but I think it is relatively low price right now. That's why ILO model has 4 options, 4 different models. So if you look at this low price model, how to look at this one. So in the custom screener, you just have to go to the state 8. In the state modeling here, you have this state targets, which is what we explained here. Yeah, the state modeling, state targets. And this is the explanation we give. So here you have to tell the system like what state you want to look at, and here I want to look at state 8, and I want to look at met today. Here met today means today the target price has been met. I mean, we all know like state modeling has 3 targets, right? Target 1, target 2, target 3. And state 8 means the downward target. So if I am predicting the state 8 at $100 point, the target 3 is at $90. So if the stock price goes today $90, hit $90, that is state 8 target 3 met today. Clear? State 8 target 3 met today. Yeah.
My target for not stop loss.
The stop loss is on the top side. Like we think that, yeah.
That's the lowest target.
Yeah, that's the lowest target.
Right.
Yeah, because we think the stock is bearish because state 8 is bearish, right? So when it goes to that level, statistically the support level is there. Statistically, it should rebound back from that point. The target 3, I mean, stop loss if it hits, then the modeling is wrong and yeah, it could go back up again, right? So target 3, so when we select target 3, you can see like if there are any stocks, and all you need to do is like now we want to focus only on the integrated oil stocks. Select the stock list, nothing is there. I can go a day back and see like if there is. Or we'll do the magic, like we'll go to October to November 2018, right? Definitely we should see some. Let's do the 2018, November, maybe.
I think you had Exxon show up in one of the studies last week, right?
Yeah. But yeah, I think we can broaden it and look at in the oil stocks. Yeah, we got 2 on that day. So I mean, you understood the process. Instead of oil stocks, if I take integrated oil stocks, it will be only that 13 stocks like what we are analyzing, right? If that's what your universe is, like stick to that, and you can save that stock list in the general settings, and whichever screen you go, automatically the stock list is pulled, right? So if you are creating a model or understanding, spending 2-3 days in one particular industry, and you created a stock list, you want to stick to that, then you go to general setting and make that as your standard one, and then whichever screen you go, it automatically pulls it in, right? So here we are seeing 2 stocks in the oil sector. I broadened the stocks to the oil stocks. I mean, instead of selecting one particular industry, integrated oil, I selected all industries. So that's what this universe has. So the CKH, this also is there 4079 is there, PSX is there. So here this particular state modeling is there. So I click on this one, it opens up in the state modeling. We are back in time. November 23rd, 2018, okay? So I gave you the example and the date also. Did I give you the date? Yeah, right. See the date is here, November 2013, 23rd, 2018. So I clicked on that, click see the state modeling again. So I think, yeah. So this is what it's saying. On November 9th of 2018, when the price was $99.74, the projection was it is going to go to 89.05, which is negative 10.7%, almost 11% drop is what is predicting, right? So we agreed that, okay, when it enters into the state 8, that could be the low price, right? I mean, the bearish momentum is going on. Anytime soon, the lowest price will come. Once my son was around 6-7 years old, like we went to Walmart, we want to buy a toy, and every toy was $15. So he kept saying like, these guys are lying. I said, well, what? Walmart, they are writing always low price, they are always high price. So, I mean, today he is in high school, $10 is nothing for him today. but $10 was a high price back then when he was 6 years, 7 years old. So it is a relatively the 10 is a number, but based on the context where we are in, based on the timing of our personal situation on the financial side. So kids change. I mean, humans change, right? For somebody who is homeless, $10 is huge money, right? For us, it's a casual money. So it's like that. $89 is a very high price stock, but we are talking in terms of relatively this stock, what was worth $99, today it's worth $89. So is it a relative price? If it goes back up again, it is a low price, right? If it goes $79, then we are wrong, right?
Yeah.
But in trading, you would want to be right 75% of the times. You are okay if you are wrong 25% of the time. That's what Josh taught us, right? That's what he defined for studies, right, Josh? Okay, so let's stick to that rule. The Delphian studies with a 75-25, 70% right is good. Anything better is good. I mean, the model which he is going to teach you is 90% model next week. So, but yes, yeah. So, and that too in ETFs and index trading, Russ. He designed that for you.
Okay, great.
Yeah. Okay. So the $89 price when it is cheap, but if you look at this is on November 23rd, 2018. By looking at this chart, would you dare to buy this stock?
No.
Huh? Yeah. Yeah. Right. From the time of the October, from the time of this top end, which was about $120 stock, came down to $90. In less than a month, it is roasted, right? This is about, this is today's price. This is reflecting today's price. Today also, again, it went into state 8 about 2 days back or whenever it went back. But see, this November 23rd is somewhere here. That 89.90, right? This is the day. This is the point where my cursor is. This is the point where it went. So it did go lower than that price. It did go lower than that price, but did it come back up? Okay. So it went to $80. It really went to $79. I did not know when I picked that number. I didn't see the chart. It's a casual number. But it went to that same price, and then it started coming back, right? Okay. Okay, let's go back a minute. So now, here. So let's go to the virtual portfolio. Let's create a virtual portfolio. All I need to do is add a virtual portfolio. I think like you went over this one a lot, right? Okay. Oil married puts. And let's give 100,000 as a test money. And let's say like a stock position, I would say no more than 3% in one particular stock, no more than 1%, maybe hybrid strategy is also 1, and exceed amount no, exceed risk also no, create. So now I created a portfolio for married puts. Now I can, okay, here I am screening here, right? Okay. Now we know CKH is what we want to analyze. So here I go to this option screener. CKH, I type in the symbol. It's not allowing me to because my percentage could be much higher. maybe I will explain this. Just give me a second. Okay. So I gave you, I mean, in the married put presentation, here I gave the option to create a virtual portfolio, how we can do it. You'll get this link as well and explain each one. Okay. So here, what we are doing is, here we are giving the input criteria. That's the married put structure. Okay. So here what we are saying is, which option should I use? Whether the put option, we are buying the stock. I mean, now CKH, right? CKH, we said, what company is it? I didn't see the name. Okay. So yeah, we are buying the stock at $89. We think the state target 3 is met. That is the lowest price. That's what we think, right? So we don't no more have to wait. Seeker holdings, yeah. So when I'm buying the stock, 100 shares, how much does it cost? $8,900. And I want to protect as much possible. There are 2 ways to protect. I can protect at a $90 strike, or I can protect at a $85 strike, or anything lower than that, or anything above that also, right? I have multiple choices to protect. So that first option is saying, does your protection, the put strike, do you want to be in the money or out of the money? Are you with me? So if I select in the money, then it is looking for a strike 90, 95, 100. If it's a $5 white strike, usually it is at that price point. So 90, 95, 100, those are my choices. That means I'm buying a stock at 89. If I am buying a $100 put, it is in the money put. I am buying a right to sell the stock at $100, right? So if you buy the stock at 89 and sell the stock at 100, you get profit. But there is a cost to the put also. The more in the money you go, the more expensive the put becomes, right? So basically you're paying upfront, but reducing the risk. So the more in the money go, you reduce the risk. But at the same time, when you marry a stock with a put in place, then you are not only reducing the risk, but when the stock starts rebounding, since you reduce the risk, your reward will be a slower reward. You will get your money very slowly. So the ideal strike is either just 1 strike above the stock price, or 1 strike or 2 strikes below the stock price. That's a sweet spot. 1, 2, 3. 1 in the money or 2 out of the money. Somewhere around like that. Huh?
3 altogether?
There are 3 strikes. Sweet spot. That's a sweet spot. Yeah, sometimes you might go, in a different price. So, okay. So that's what you are saying, the first column. The second column shows, okay, how long you want the protection. Do you want the protection to be for a 90 days expiration, or 180 days, or a year? Typically, when the stock is beaten up and it is in state 8, and you're buying at a cheaper price relatively, right? And the stock is beaten up for a reason. It could be multiple reasons. This time of the year, it was market. But sometimes it may not be the market. It might be the stock itself, right? So there could be n number of reasons, but the moment it is in state 8, if you want to buy the stock, you give yourself at least 6-7 months. 6 months, yeah, at least 6 months, 180. That will give the company owners, when Warren Buffett is buying, he gives at least 10 years. He's investing, we are trading, right? So we are giving 6 months. Because the stock is so low, they have to recover the whole money through the positive building measures, through the earnings, and the only time they will have to come and out in the public and tell people officially is through the earnings. Unofficially, there are leaks, there are rumors, there are analysts talking about the stock, but those move the stock only to some extent. Only when the earnings report comes, when the management comes and talks about it, when that written report is there, that one is there, that's when like the stock will have much momentum for the future months, right? So that's why I give at least 6 months, 180 days over there, at least. So, and the portfolio size is just 100K, and in this particular screen, if you, I mean, for a testing reason, for learning, 100K is fine. But if you are trading 50K, put 50K. But if you're trading about 150, put 150. Whatever your real portfolio, in that particular portfolio, what you want to measure the risk against. That's what that parameter is. And capital risk, it's not recommended no more than 2% in one particular single trade. And I personally like 1.5, no more than that, unless it's a very, I mean, Netflix usually takes about 2%. So there are some stocks, like if I have to buy Tesla, like it's about 4%, otherwise I can't buy the Tesla stock, right? So it's a higher risk, higher reward stocks, like, so those are the ones. So I would allow only about that best practice 1 to 2.5%. And the position risk, here, how much money are we investing here? $8,900, right? If I'm buying 100 shares, $8,900 is what we are investing, correct? Yeah. So if I put here 10%, that means I don't want to lose no more than $890, my overall net risk, right? Okay. If the minimum net delta, one stock is 1 delta, 100 shares is 100 delta. But if I'm buying at the money put, and if the put has a negative delta of 50, my 100 shares minus 50 delta, what is the net delta I have? 50 delta. That means, in short, when I combine my stock position and put position, look at them together as one position, then what I am saying, for every dollar rise in price, I want to take 50-cent profit. Got it? For every dollar rise in stock, I need 50-cent profit. Sometimes you can say I need net delta as a 40 or net delta as a 30 for whatever reason. You put in your number there, favorite number there. I wouldn't suggest like no more than 50 over there, even though we give option as a tool choice, but no more than 50. You need to have at least 50. I mean, I can buy the 100 strike put also, but it will reduce my net delta to 30 cents. So the lower the risk I make, the net delta also will be like, it's a direct equation, like high risk, high reward, low risk, low reward, right? So right in between, right risk, right reward is 50. Okay. So if you stay in that sweet spot, usually it will be like 48 delta, net 48 delta, or net 50 delta. You'll be very close. You can do a 45, 48 also, like so. You'll have more success doing that. Okay, then the display is by default, it's 1. Show me only one choice. But sometimes you may want to see like, let me see the other net deltas. You may say 5 and then it will open up five choices. Let's see like if it does that on the software. Why are we talking about 89? It's $40 stock.
50 or you did 40?
Yeah, that's the other one, I think. See, I mean, the lower the price the stock, like it takes this one. So now it's showing, I asked for 5 choices, but it's showing only 2 choices. Here you see like the risk is about 0.74. If I buy the 35 strike and buy the stock at $40, 40.79, then it's showing like 0.74 risk. From a portfolio standpoint, I am fine. Less than 1% portfolio risk, right? I have $100,000. I am risking $739. Okay, but when I'm investing $4,079 plus whatever this put cost me, and essentially I'm investing around plus this $739 plus 40.79. So for the $4,100, this $739 is 17% of the overall capital allocated to that fund. My total money allocated is $4,100. I'm guaranteed not to lose no more than $739 by any means before the July time frame, right? Excuse me. Okay. So I'm guaranteed not to lose no more than $739 out of the total investment, which is 17% total risk. And if I buy the $40 strike, my total investment risk after the capital allocated is still the same $4,500, nearly $200 less, but I'm reducing that to 9.38%. So in this case, which option would you buy if I show you these options? 40 delta, right? Everyone with me?
But you're still making money as it goes up.
Yeah. As it goes up, I will still make money. If I buy 35 delta, I will make 77 cents for every dollar that goes up because net delta is $77. Net delta is $77. 77 cents. That's in cents. Because, see, if I buy 35 strike, this is the net delta, right? Yeah. Yeah, correct. It's farther out. The put is farther out. So when it is recovering, the put will still lose money, but you invested less and your net delta is more. The rate at which your put loses money is much less than what 40 strike will lose. That's correct. Yeah.
Are you in the money?
No, it's out of the money. It's 35.
30, oh, 30.
Yeah, out of the money. Yeah. So here if the net delta, so this is the reward column, net delta is the reward column. This is the risk dollars. This is the risk in terms of the overall portfolio. If I am dead wrong and the stock goes to zero, my portfolio will be down by $739 in the first choice, and the second choice, my portfolio will be down by $414. Within the $100,000, $100K portfolio, that's the dollar number which will be reduced by now. Even though I bought stock at $4,100, they will give me back the rest of the money, right? Somebody sold me these puts. Somebody sold me those puts. So that's how you get assigned, and then they will have to pay you.
What's the, for every dollar that it falls, that the stock falls, what's the gain from the put?
The 40 strike, yeah, 40 strike will gain quickly when it falls down. It's exactly the reverse.
Just the reverse.
Just the reverse. The 30 than the 35. 35 will gain slower than the 40 strike. But at this point, we think the stock will reverse back up and go back up.
Well, remember that we saw the picture, it was a 89 down to 79. Let's say this went down to $30. Then you got 180 days, I guess you just sit. for 180 days.
Yeah, that's true. You allocated 4,100, you sit there, but if it doesn't come back,
Right.
and then you lose $400. I mean, that whatever strike you take, right? You lose $400. But you are giving enough time. Usually, within the next 2 months, if it doesn't do anything, then it's dead money.
Right.
Usually,
Yeah.
it should be very quick to come back up. So usually that's what the state modeling says. Okay, so now let me switch to this other Prezi. You're getting this Prezi as well.
Oh, so you would exit after 2 months? You yourself?
You can, but usually I completely leave it. Yeah, you can.
Dead or not?
Yeah, yeah.
Reassess in 2 months.
Yeah, correct. Okay, so we are at this point. I think, where did we see this? Forget that.
You just have the $78.
Yeah,
But that's okay, because it went down $10 and then came back to original price.
yeah.
So you lose the $400.
Yeah. No, you probably don't lose it. Like you'll make it back. So let me come back to this point in the software, and I'll show you that one. So state targets, state 8 met today, target 3. Then I want to select oil stocks. Okay, I get to that. Okay, here we have. So we went to this, we passed that, right? We came here. Options, screener. Now we know CKH. Out of the money, 180 days, 100, 1%, 15%, 50, display 1. We are happy with 40? 40 strike? Okay. So here we have a plus sign, right? You hit this plus sign, it will go to the create position stake. We are happy with the $40 put. We are happy to buy the stock at 40.79. Okay, so here it shows the same metrics, a little more in detail, and the graphical way of showing it. And it already carried this 30 merit puts as the default one, but I created this one. I want this to be in this portfolio. I changed that, create. Now the position is successfully created. Okay, now this is the, you see that net delta, here there will be a, yeah. See, this is the delta, 39 for that one, and 100 for this 100 shares. So net delta will be here. Do you see it?
Yeah, back, gain loss, the green zeros.
Oh yeah, position delta. Yeah, yeah. This is 60 delta. So for every dollar it goes up, then we have about $60 gain, right? In Delphion, I mean, since we are doing in hindsight, we can always go and say 2019. Let's go. Let's keep it. This is in July expiration, right? Let's go back to July. Like it's not going to hurt. July 10th. So it's going to show you like how this position. If you click on this link, this merit put link, it will specifically show only that one link. What it's showing in the previous window is if there are about 5-6 positions on that portfolio, it's showing the whole graph for whole portfolio. If it's only one position, that's equal. But here you can see this one, right? This is where we bought the stock. And after we bought the stock, it went to 35 delta, 35 price from $40 price point, from $40 price point where we bought 40.79. The lowest it went is around 34.96, right? and then highest it went is $47. By this time, the 440, what was the risk amount what we risked? $414. If you take 100% of your money, what you're risking, $414, somebody gives you 414 matching, would you be happy in month, 2 months, right? So that's exactly what happened here. So the profit here on that day was $446. We would exit our position by that time. Because our risk is $414. All I'm looking for is give me $414 profit. I'm going to release my position.
So what did the put cost and what was it worth after 2 months?
Okay. We can go to that February 25th, 2019. So just go there, February 25th. Yeah, we can see, but he wanted to see what the put prices are on that day. So here the put was costing, this is the $40 strike put. That day it's valued $68. So we paid $335. So, and then today's value is $68. So we lost about $267 from that put strike. Yeah, but you made a dollar for a dollar profit on the stock leg. So the stock leg made $732. Both together, it's $414. This is where I want you to focus on. When you do a married put, don't focus on how much put is losing at all. I don't even see that how much put is losing at all. In my live positions, I always combine put and a stock. I don't care how much the put loses. The more the put loses, the better it is for me. Because I want put to lose, because I'm losing 50 cents, I'm gaining $1. Right? For every dollar raise, I lose 50 cents. So the more I lose, the more better it is. Right? So you would want your put to lose because of the price, not because of the time. Okay?
Ashok, do you have to look at that every day, or can you set your?
Yeah. I mean,
You set it
yeah.
to-
Yeah.
Because it's state aid.
No. The question is like you, from a real trading standpoint, right?
Yeah. I mean,
Yeah. Just put a limit order there, like,
and then order for whatever.
yeah.
Okay.
Yeah, whatever. Like, so this, I mean, if you're using Tradier, it's pretty simple. Like, you go to this position, like, you just put a limit order there, net credit, and you calculate the $4 more. For 4,100 you bought, right? 4,500 you type it in, good to cancel order. That's it. That will stay. Whenever you get that 100% profit, it will close. If you're using Thinkorswim or any other brokerage platform, same process. Okay, so I mean, one advantage to put it in Delphian, if you open the order as a married put and use Tradier, it always stays together as one position. If it doesn't stay together, you can also link both legs together, because you would want to look at the results same way linked, right? In Delphian, we give the functionality of, okay, for whatever reason you closed a put because we lost money, we gained money on the put, and you cashed the put, and then you bought another put under the protection. We'll go over that one also. That example also will go over. Then you can combine them too as well in Delphian platform. Okay, so here we would exit at this point, right? I mean, more so like here itself we will exit. On this February 21, we will exit because it's 421. As long as they give me about 100% of the risk, $414, I'm happy, right? For the,
5% in 2 months.
yeah. For the 4,000, the whole amount, the capital whole amount, you made about 10%. Oh, 5% per a month. Yeah, correct. 5% per a month, which is much better than 1%, 2%, right? Or better than the high yield savings account. Yeah. Or the risk-free rate of return. So, okay. So now, if we go back to Prezi, so the rebound model adds it's still the same as a low price. You think the low price is low from a state 8 target 3 met today. The only change we are doing is we are changing from a met today to met, meaning I know $40 is a $40 target 3 has been hit on this stock, but I want to wait a little longer because the 40 could go to 35. What if I can buy it at 35? I don't know, right? I don't know. It could be a missed opportunity. That means out of 10 times, we would have made the 100% profit on the other side. There could be only 5 opportunities actually because I waited longer. The stock price might have gone up, reversed it, gone up. I might not have got an opportunity. There might be a lost opportunity. But I'm not too much worried because in this account, what I'm showing, like there's 150,000, there is only so much I can buy, right? And I don't want quantity. I want high quality trades, not the quantity, because there's only so much I can invest with that amount of money. If I have $10 million in a portfolio, yeah, different story. I need more stocks. Yeah.
Risk say 2% on 100,000. You can have 100 shares of the first thing and 100 shares of that.
That's correct. Yeah, that's how you distribute it. That's true. Yeah, you can practice both. You can practice both, and then yeah, you can do that. So the only change is I want that to be met, and after meeting that one, I would want a Bollinger Band drop. I would want the market to drop the stock much more than what it should have dropped. Okay, so one standard deviation drop usually happens less than 35% of the times. 2 standard deviation drops, meaning today is $40, the 2 standard deviation drop, let's say $35 price. So a $5 drop on a $40 on this particular stock happens only, there is only a 5% chance for the stock to drop below $35. If I say that, and if the market really drops below 35, what would happen? The institutional investors and the traders, everybody will see like, okay, this is a rarest of the opportunity. This happens only 5% of the times. Let's buy it, right? So the stock comes back to the reversion to the mean model. They will start buying it. The more the buying happens, the stock keeps pushing, right? Okay.
You place this trade to wait until it comes down.
Furthermore.
Entire trade is going to sit there and wait.
Yeah. You're not going to open the trade. You're going to wait.
So it waits until that
Drop it.
and
That's correct. Yeah.
What was that value? Did you come on there?
2 standard 20-day SMA.
No, you didn't mark anything on that value.
No, we marked it. 20-day,
20 days.
2 less than 0.
Oh, 0.
Oh yeah, I keyed in 0 like so. Here, yeah. It's a percent B is nothing but it's the same thing as Bollinger Band. It's a little easier way of telling that one. If you hadn't gone through that one, like we'll give you a video on that one. So.
You are going to send this
Yeah,
with the check mark?
that's correct. With the values in it, as is you will get it. So if you look at it, this is our day. This is our November target 3 met date, right? We were going to buy here 40.79. We did buy that in the portfolio, correct? So in that scenario, this green band under the lower Bollinger Band, this is the buy band. Buy band means like the way Delphian in color we indicated is when it drops below, that means it's oversold. Now it's a time to buy. Easy?
Buy both stock and the.
Yeah, put also. Anytime like buy stock and buy put, protect it in the same model what I showed you. Okay, but here we are showing, okay, this is drop below Bollinger Band.
Don't you want to close below?
Close below it. I mean, but the day we close below, the way the ILO works is you don't want the target 3 on the same day and not in the near vicinity. I mean, 2-3 days, like, give it about 3 days. after the target is met, you would want the cushion to be given, right? So ideally, so this particular complete area, this area I would eliminate. This is the day where the target 3 was met. I would eliminate this area. And next day it all inside the band. This is the day it closed below. So I would buy it at $35, right at $35. Will I make money?
37.
Yeah.
Yeah, sure.
Yeah, or 37. Yeah, maybe a little bit higher. Maybe this day, mathematically, right? Or this day. Yeah. Yeah, this day. So if I bought it for $37, did I make money instead of $40?
So
Yeah.
you placed the trade on there.
No, we did not.
Oh,
Yeah, we saw, okay, state 8, target 3 met. I know it is the lowest price. I am willing to lose a trade, but I'm going to see if it's going to drop much more.
You are the one waiting.
Yeah, I am the one waiting.
Exactly. You placed the trade
No.
and let the genie take it.
No. I did not do that. So I would give it 2-3 days. I don't care about the lower Bollinger Band, but I would after 2-3 days, whenever it comes below this band, that's the day I'm going to place, and this is the day where I'm going to place at a $37. So instead of $40.79, which is nearly $41, so I'm going to buy it $4 below. Okay?
But at that time, don't you think that it is going to cost more?
Yeah, we do. You have to do the analysis again. So let's take a look at that date. So once you look at this chart, let me open the chart in the application. And indicator, Bollinger Band. See, this is the day we are talking about. No, not too far, too far.
Right there. Right hand side.
Here, right? Yeah,
37.
right. This one. Okay. Yeah. So this is the day, December 19, 2018. So December 19, 2018, I would go to December. Not in this screen. December 19, 2018. I do the same conditions.
Bunch of stocks up.
Huh? Yeah. Right. That's why we went directly to that one. See here on 3069, here it's saying buy 35 strike. And you're risking the same $442. It's doing all the analysis for you. Slightly higher, like we're risking about 11%. See, what happens when the price of the stock goes lower? Now you are investing only $3,500 plus whatever this thing. So even if you're losing the same $400 for a 4,100 against a $400 versus $3,500, the percentage is higher, right? That's why, like when you are trading merit puts, the ideal place to trade the stocks is at least around $40. Anywhere between $40 to $200 is worth, because a $150 stock can easily go to $250 stock. The momentum that it can get is very high. Likewise, a $40 stock can become a $80 stock. How many times we have seen the stories, right? Whereas $800 stock, if you want to buy, even though it has this high-low momentum and everything, but it costs you $80,000, and you're giving 6 months, and you're blocking all your 100,000, unless your portfolio is in millions. I mean, even though you're getting 100 out of 100, but in the meantime, instead you're using 20 stocks. Instead of 80,000, you can allocate to maybe 5-6 stocks instead of one stock, and 5 of them are making about 100% of out of 100, and one you are losing, net, you're going to be making more than the buying the $800 stock, right? That's what I'm calling it as a trading strategy.
Yeah, so if it was $100 stock, maybe it would cost you, instead of $400,
$800 risk.
you would get out of that. You're still gonna get the same annualized return.
That's correct. I mean, before you leave, we'll do the Microsoft and show like $179 stock. We'll see the Microsoft also, and we'll see Apple as well, like so, as an example. Like so. Okay. So here, okay, I'm going to do a plus. Same thing.
Gotta wait till it's a state aid.
Yeah. Yeah. Oil married puts. Position portfolio. And it shows that portfolio is will be shown with that one. And then we can move forward to July 10th, likewise. Oh, 2019. Okay. So this is what we bought after waiting, right?
Yes.
So by February 25th, by that day, how much money did we make? 904, right? For a $440, are we 200% there? Don't look at $3,500 total capital investment and look at how much risk you are doing, how much percentage of the risk. And in 2 months, you calculate now you got 10% per month for that money, right? Imagine you're distributing over $100,000 into 7 or 8 stocks, and then 1 failure and 6 successful.
But your logic for the last one was getting the risk amount and exiting at that point.
Yes.
Here, what's your logic? Of your
No,
exit?
the same thing. 100 out of 100. I always cycle back that money. The moment it comes to 441, this is the day I would exit. I would not wait until here, this point.
Right. Okay.
I would exit 100 out of 100. My rules are same. 100 out of 100. Unless you get the level of experience like me, your rules are same. If you get 100% for your money, exit.
That's good.
Yeah.
So for this, you do 100 versus 25% on everything else.
Yes, correct. I mean, the Delphian studies is all 25%.
Right.
Yeah. And because those are all only optionable options, which are all decaying assets and high risk, and I mean, if the stock turns back on you, it takes longer to come back on the option side of it. Here we have a stock leg, right? The stock leg is pulling 100 delta at a faster rate. Here also you will lose money, but the level of money you will lose is much less when compared to those other options. Like, I mean, it takes a lot more price movement to get back to the same level in those other strategies, in the option strategies. In this strategy, you're fine. 100 out of 100 is fine. You need at least 100, because for every, let's say like you are 80% successful. For every 10 stocks you do it, 8 stocks you are successful and 2 stocks you lost money, right? That means net you are 60%, making 60%. But since you are making about 10% of the money, the $400 is not going to dent you. Like, let's say like eight of them you got $400 each. 3,200 you got. 2 of them you lost 400, 800, 2,400. In 2 months, we make 2,400 on about $40,000 portfolio. How much does it make? 8%, nearly about 78%. Yeah.
I didn't get the point of losing, because we are buying so low. Where is the point of?
It can go still low. It can go to 0. The stock can go to 0, right? State modeling thinks it's low, according to state modeling. State modeling is not the holy grail and the holy Bible that the stock market. Yeah, correct. It's a probably low. That's what you are saying.
So you wait until all those 2 months to make the decision to exit. You are continuing.
No. You're exiting. You at the point of entry, you know your exit point.
Right.
I mean, on the day you enter, you are risking $400. I want to make $400. That's it.
That's
But how many days we are going to wait until
within the 6 months, within the 180 days. I mean, we already decided that also, right? Correct. Put expiration, we bought it 180 days.
So on 6 months you have to
That's correct.
continue to watch.
Correct. Last year I bought Netflix under the married put model. I did not make money. I lost $2,700 on that position. I waited about a year. Stock did not go down. I mean, the stock did not go up from the point where I bought it. So I lost money on that one.
It was never in state aid.
It,
Netflix.
I bought it late. I did not buy this way, and I bought it in a different way. I should have bought it about $50 lower than what I bought actually. Then I would have made money, and then exited out, right? But out of all the entire positions I bought, that one and Oracle did not do much. I bought it for $50, $52 or something. Honeywell is another stock. These 3 stocks did not make money for me last year, last 4 or 5 months. But rest of everything made money, like so. But I mean, I bought Apple for 157 and Baidu for 100 and Nvidia for 140, 167, I think, 167 or something. Like everything else made money, and I did not sell it 100 for 100. I did not sell as soon as I got 100% profit. I did not sell it. I managed in a different way, and I left the stock open, let it ride, and I kept raising my risk coverage. And net I said, like, I'm a $0 risk. I'm going to lose the market money. I'm playing on house money, and I raised it. So you can be at that level too. It's not hard. You just have to practice this step number 1 first. Once you do this, I can tell you like those steps. If I tell you today, you'll be lost. So that's why I'm stopping.
So you said that 1.5%, 2%. The amount of capital that you locked up is much more than that.
That's correct.
What is the 2%? That is the $400 loss you're talking about?
No. Hypothetically, if you identify 10 stocks at a $40 price, if you invest in them, you're investing $40,000. Correct? Assume for every stock you are picking up, you are risking around $400 to $500 risk. Maximum, you are risking around $5,000. So your entire portfolio, if the stock market shuts down the company, exchanges shut down, all the companies are gone to zero, they will give back you $35. $35,000 is back to you in your account. You lose only $5,000. Whereas rest of the public lost a lot of money because they didn't buy the put. Because you bought the puts, then you are losing only $5,000. So your risk is at a portfolio level, maximum you could lose is 10-12%. Correct? Okay. At the same time, out of those 10 stocks you bought, 8 worked in your way, and you gained $4,000, but you lost 2 of them. You lost $800. So net you made $3,200 gain. The $3,200 versus the $40,000 in 2 months. So per month it is $1,600. How much percent is it? That's what we calculated. Yeah. It's a 4% actually, I think. Yeah.
In our, let's say, high probability strategies that we've been looking at so far, pretty much get into those when the market, S&P/Russell are in uptrends. In this scenario, it seems like it should be sort of the same, but you don't worry about equipment and reversal in between.
No need to look at the market. This is so simple. So simple, no need to look at the markets at all. Each individual stock, but I'm going to take healthy companies. I mean, I'm not going to take Hess as a company and then look at this one and then do the similar trade. I mean, you can do, there's nothing wrong, but it may not come back up. I mean, see this stock moving about $6-7. I mean, we have to look at the fundamentals of this stock and then say, okay, this is in my portfolio. And once it's in your portfolio, then that's it. You do it blindly. No need of looking at the market. What is the overall market doing and all, like, because market also swings, right, up and down. These stocks also swing up and down. So once it swings 100%, take it out. Then look for another opportunity. Like Winslow is saying, like, yeah, you have to have patience. Not every day you will find stocks. I mean, but you'll find a I mean, 2 a week, 3 a week, isn't that sufficient? Yeah.
So what I'm hearing is this is going to be an ILO strategy in the Delphi.
That's correct.
You press it. Is it going to use the high probability stocks, or is it going to have another subset?
It's going
other
to,
than the high probability.
you have to
Liquid, but
select the model. And tomorrow when we release, this is how it's going to look like. Low price, rebound, reverse, uptrend. In this in the left-hand corner, we'll explain what it is. But what I explained, state 8, target 3 is this one, low price. And this rebound will include the Bollinger Band.
Yeah, that's beauty.
Bollinger Band model also. Leave out all the details. I mean, you don't have to worry about, okay, 20-day, 2-day, 0 parameter, all that you have to, I mean, I'm giving you all those rules, but you don't need to do anything like so.
Are you going to use on a simple list a refined list, or is it going to be your?
No. This is not going to be a study. This is going to be available to you, and you can choose your own list and do that one. So yeah, but this is how it's going to reflect. I mean, the moment you say rebound, this is what is happening. It's looking for a Bollinger Band low, and then when it's going to come back up, and that's what it's looking.
Wait and see if it goes down again.
No. Buy it.
So it's already at that second point.
That's correct. If the under this signal, under this choice, if you see the stock, that's when you need to go and do the option screener, married put analysis, select the strike and select the expiration and click create a trade. That's it.
And you're gonna be able to run this against your selected group of stocks or
Or the
group
single.
of stocks on liquid options.
That's correct. Yeah, you can run it on all stocks, or you can select only group of stocks, or either one. So even though I'm explaining rules for each of these, you don't need to worry about, okay, what parameter did Ashok give, like what do I need to do, like this is just, as long as you know that custom screener like Delphian ILO button and then select the choice. So each one has its own merits. I mean, this is, you are buying it a little bit early. I mean, if you wait for the rebound, you may lose some trades. You may lose some opportunities. But for example, for this stock, there may be 10 opportunities in a 10-year period for this option. For this option, there could be only 5 opportunities because you waited and then the stock did not come to your point. I mean, sometimes my wife says like, okay, I want to buy this. Oh, it's $150. No, I would want until it's $100. I keep telling, like, give them the price and give them our phone number. They'll call you. Like, right? She doesn't see value in buying at 150. Like, she's not going to use much. But at $100, she doesn't find. She's okay to buy. So that is a price point. So I mean, yeah, who knows? Like, I mean, sometimes like when I said that the next year or the Thanksgiving sale or whatever, like, I mean, she buys at $80. Some of them she never gets that one. She wants a Apple Watch for $300. I mean, the model she wants. They never come. Yeah.
Oh, okay.
So she never hit that one. So it's a chance, right? I mean, if it is like I desperately want this one, then you don't care about the price. You go buy, right? If it's like okay, if I get this, I'll buy it. Otherwise, I'm not worried about it. My mind is not on it. Then that's what these choices are. If you say low price, you'll get more hits. If you wait for the rebound, then you might lose 50% of the low price chances, but you get quality trades. Got it? You're with me? Okay. Now, let's take another notch up. Instead of, okay, let me go. Now the reversal model. Reversal model is saying still the same, state modeling met target 3, still the same. And you see, this is my, actually, it's changed. Yeah. See, this is the point where our target is met, right? The $40.79, right? So, I mean, I think this model changed a little bit. This line changed a little bit on me next. It's not letting me add. Okay. This line dropped a little bit more. So ideally, this is the point, this TP3, wherever TP3 is there, that's our buying point initially, which is at 30 or $40.79. So in the rebound model, yeah, now it's coming here. In the rebound model, we are able to buy it here. In the reversal model,
Move it back.
yeah. Yeah. So in the reversal model, what it's showing is, see, this is the point where it closed above this price. So all this time is dead money. All this time is my money is locked up. I don't want that to be locked up. I'm okay buying at $40.79, but I don't want to buy it now. Let it go lower, much lower, then come back up and cross above that line, which is about somewhere around this area where it crossed mathematically. System will tell you correctly where it bought, where you need to buy. So somewhere at this level on January 10th or 15th level in this week, I will do the same thing. I go to the married put analysis. If it tells me $40 strike, I buy that one. And what happened immediately after that?
So does it send you an alert? To say,
If you lock it, yeah, it will send you that one. If you create a daily alert, yeah, it will do it for you. It will tell you like, okay, CKH moved this price, ILO reversal model, and it will tell you clearly. Yeah.
there is a command you can leave it there to let you know when it's ready.
So the only difference is here it took 2 months for you to make money. Here it took about 1.5 months here to make your 100%, or 1 month, whatever point it is. See, on this stock, it perfectly worked fine. But what if the stock keeps going back down and all, like for reversal, you don't lose money, right? You're not buying it because it never came back up. And if it never comes back up in the next 3 months, you're going to ignore the signal. You're going to say like, okay, I'm done. Yeah, because you are already getting another set of stocks in the state 8, target 3, you're waiting for reversal. Your money will be always in trading. Money is your inventory. You need the inventory to be, if my inventory is sitting in my warehouse, do I make money? No, right? Okay, my inventory has to move warehouse. But the question is, my employees will say, your warehouse is never empty. But yeah, I would never want to be empty, but I would never want the same piece of what I put today to be there tomorrow. I keep moving it, moving in, moving out. Money, inventory, new inventory comes in, even if the same piece of box, I want the manufactured today date to go out and sell tomorrow. And then today date, like today manufactured should come in, right? It's a cycle. As long as the inventory keeps moving, I want my employees to be busy and they load, unload, load, unload, load, unload. That's how I make money in business. Same thing, money is your inventory. You are your own boss and you are your own employee. Your brain is your employee and your tools are your employees, right? And your risk is your boss. So the moment you focus on risk and reward, risk, reward, risk, reward, and cycle it, it's an easy strategy, no stress strategy. You don't need to learn any Greeks, anything at all. If you learn married put and you are happy with 100, 100 and these models, that's it. You don't need to learn anymore. That doesn't mean you don't have to come to the seminars.
Retraining our brains. Yes.
Yeah.
You still have to choose your own strike prices?
No, I mean, the analysis is there, right?
It's run in
See here, let's say on the January, let's go to the January 10th time frame, 19. That's when it reversed out to back to the same price on the same stock. I still have these parameters on the CKH. Say I'm buying at $40.79. It's doing analysis. $40. I just hit button. And if I'm trading live, I'll just say like hit live button, like so. And it sends directly to the trader.
It's 3:37 this, but it's a shorter time.
Shorter time. So you're waiting for that to reverse back. That means you probably will miss some opportunities, but those some opportunities are fine. So I mean, you're using your inventory effectively, right? Yeah. See here. Here also you are risking the. I mean, no, not this one. Like so. Hit the. Let's do it again.
Usually you have the price bracket, the price average 4,200, 4,270 stocks.
You can create that way also, but when we remember we selected the sector, you can also give price also, because we are not going to buy anyway Amazon stock unless you have a millions of dollars portfolio. You're not going to buy that as a stock, right? For this married put candidates, I would suggest like prepare your married put candidates. The way I do it is like ideally I buy it. If Apple was $270, I would not have bought it. Apple was $157, I bought it. Like that, because there is a greater proportion of, I mean, it's easier for a lower price stock become doubling versus $250 stock doubling to $500, right? So exactly, 40 to 100 bucks is a sweet spot, 40 to 100 bucks, but not many $40 stocks become $100 stocks. So when you go to the $100 league, that's a different league. I mean, it's just a league level. Like so, if you play in NBA championship, and before that there are different levels of leagues, right? So if you're able to play in the school, then you can go to the district level. If you're able to play in the district level, then you go to the state level, right? Like that, the stocks also move in that buckets: 40 to 100, 100 to 200, 200 to 500, 500 and above. 500 and above, it's all the same. I mean, it's an institutional investor. Like the reason why the stock split when they go to around $1,000 stocks is because of increasing participation. They want to increase participation. That way, like more participation and more investment comes in. I mean, people who are not able to, I mean, people who are earning about saving of $100,000, they can't afford a $500 stock, right? Even though no matter how much they love it, they cannot afford that one to buy and keep it, right? If it's a $10,000 stock, then more participation will be there. It's the same thing. Instead of one person doing it, we are saying like 5 people can participate. So that's what we are essentially doing. When stock splits happen at a higher price, that's what they want to encourage. They want to encourage more participation. More participation in the long run is much better because it will increase over a period of time, like it will increase. Because not everybody will sell the stocks. Like so, if we hold the stocks for, there are people who bought Apple when it was $99 or $100. They might be still holding it. It's a low cost, low risk for them at this point, right? As long as they know how to protect it. If it goes back to 100, I mean 100 back again, my money is protected at a, I don't remember the strikes, but at a 215 or 230, I think, yeah, 285 or something like that, it's protected there. Yeah, I have a put at 285, and I sold at 330 or something like that, like a call also, because I want to, when it comes back down, like I'll position and make money on the call side also. So that's how I adjusted that one. So to me, tomorrow if Apple goes down, I don't care. So it's not my money anymore. My money is at risk anymore. I got all my money, and I got the profits protected, and I will lose. It will reduce by $1,000, but it's better than like losing all $300, right? $30,000, right? Reducing the profit, $100,000 reduction in profit is much better than losing money. Correct? When you double the stock money. So yeah, so this also I'll select oil merit put and create.
Ashok, I think you mentioned in the last seminar that you were buying a put on a put to pay it off.
Oh yeah, I will.
Did you do that?
Yeah, sure. On Apple we'll do that. On Microsoft we'll do that, and I will explain the reason why also.
Okay.
I wouldn't do it on the oil stocks because okay, when I go to cover the next one, I will do that, but not on the oil stocks. We'll jump to the Microsoft and Apple, and then I'll show that model. Okay, so here see, for pretty much here I'm risking $387, $442, $442. So here also, like if I open that and jump a few months ahead, we can see when the selling point was. Here I need only $300 off for a $300 profit. See here immediately I would have exited in less than about the very 2-3 days of price bump, like we would have got our money, right? Then we exit. It's easy thumb rule. Like, I mean, in the starting days, 100 out of 100, and you're giving 6 months for time to recover, right? Okay. So now on the same day, I think we got one more. I'm going to close. Oh, let's do it again. Oh, wrong date. So this PSX stock, I think what is this PSX stock? Phillips 66. Even in Delphian, without opening the annual reports, if you go to this, click on the symbol, it will take you to the stock overview. You can see Phillips 66 is a downstream energy company. It operates in 3 segments: refining, marketing, midstream, and chemicals. Refining and marketing segment purchases, refines, transports, and mainly in the United States, and engages in this one. The midstream gathers, process. It's explaining that one. It's headquartered in Houston, Texas. So now you will be able to understand this, what you are reading, right? Yeah. Okay. So this stock, it came up on the CKH day. It came up on this same day, right? For the same ILO model. You look at this chart. Look at this chart. So this is our buy point. Okay, this is somewhere around November. This one is our buy point. Let's expand a little bit. This is our November 23, right? This is our drop. So looking at this, a $125 stock dropping to around this one, state 8, target 3 met on that day. That's what our screener came up, right? Okay. So it dropped much beyond, and then it went back up again. Would we make money? We would have made money when we bought 78 or 91. We would have made money like when it went to 97, right? Would have bought our 100% profit. So let's say like if this price movement did not happen in this time frame at all, meaning like in the first 3 months, 60 calendar days, 60 candlesticks, it never came back up again. In the reversal model, we would totally ignore. Don't buy. After that, it doesn't matter. Because 60 days, 60 calendar day, trading days is much beyond where the state modeling will keep changing. It went into a different state and came back again. A new state 8 triggered, and unless you get a new state 8 target 3 met, you're not going to take into consideration. Got it? But if you all these rules, if you use that ILO button, it's all only for knowledge purpose. You click that, you know what it is. That's it. Okay. Now in the state 8 model, in the next one, last one we have. In the uptrend model, again, when the stock transitioned to state 1, we think the stock is going to go up. In that way, it is a low price today. Got it? But Okay, one way to look at is there is a signal called state model and transition state 1 buy the stock and the stock price could go higher. But there is one more signal here. This signal, this is called risk reward, I think. Everybody should have it, like you should have it as well right now. So the risk reward ratio. This is talking about state 1, target 1 is greater than 8%. Remember, target 1, target 2, target 3 has different percentages of return, right? So the expected target 1 is 8%. And you are buying a $40 stock. That means we are expecting at least a $3 movement, because remember, we make money only when 50 cents for a dollar, right? We make money only when it goes 50 cents for every dollar movement. So if you are buying a $40 stock and you are risking around $500, you need $10 movement, right? I mean, you need a higher price movement, which is very difficult. That's why if it is a 5% movement only predicted, we don't buy the stock. But if it is beyond 5%, I mean beyond 8%, that is the ideal sweet spot point. Okay, now I am interested in this stock. And even if it is a $100 stock, if it has to be 8%, because our put is going to be costly, our risk is going to be more higher. Instead of $400 risk, our risk will be $800 risk in a $100 stock. Are you with me? And at the same time, oh,
They're not going from 8 to 1. This is going from 1 to 2.
yeah, correct. I mean, eventually it will go to, the stock which is at 8 will reverse back. It will go to 7, 5, 3, 1. And we are buying at a 1 point. We don't need the middle ones. We either want like whatever the stock that has extremely fallen, the chart would, most people where you wouldn't buy the stock, right? I mean, technical traditional analysis, like people who explain you the charts, they'll say the chart is falling, don't buy, this is not a good point to buy, and all this stuff, right? So that's what we are going against and then saying, okay, I'm going to buy, I'm going to protect with a low risk, high rebound probability, and we are going to come out fast. And other way of doing it is state 1, it's going to go up, and it has at least 8% movement. And if it goes to target 3, I make more money. But even in that case also, if I risk $800, what should be my profit target? $800, 100% profit on my risk. And there's one more thing. We need to add the stock needs to be moving. There is a signal called average true range indicator. You can read up online, like there is a mathematical calculation. In stock charts is a good site like which explains the calculations also. It takes the today's high low as well as yesterday's close to calculate the ATR value. So once it comes up with the right value, that's what we will divide that by the price in terms of percentage, how fast it is moving. Like a ATR of 2 on a $40 stock and ATR value 2 on a $100 stock, which is moving faster. That's the concept. So your relative speed of the price movement, because you would want to catch the CKH, how we found the reversal model, we caught it and it went up, right? You ideally want that is a point. That is a point where you buy it, next day like the stock should go up, correct? If that happens all the time, yeah, but if that happens all the time, then we don't have to do anything at all. Don't learn anything, right? Keep doing that. Buy and then take the money off, right? So that's exactly what this particular indicator will talk about. But if you select the uptrend option in the ILO, this is all inbuilt in that. You don't need to know this one. This is all inbuilt in that.
So this is incorporated with that.
That's correct.
So what's your exit price on this strategy?
100% risk, 100% profit, 100% risk. Yeah.
given that that in stage 1, there are target 1, target 2, target 3.
Mhm.
So are you talking the bigger movement from target 1 to target 2, or you
Uh-uh.
saying you're not
No,
just
no.
defined?
On the day of today I said state 1. Today the Apple, let's pretend Apple is going to state 1 today. I will look at what is the projected target 1%. And if it is at least 8%, then I would trade that. I don't know in future if it will go or it will reverse back down. I don't know. State 1 has a 65% probability to be hitting the target 1%. When I say this stock has hit state 1, and it has a 65% probability to whatever target I say, whatever target 1 I say, it has a 65% probability. That's how the mathematical statistical calculation is done, how those levels are calculated. So they still have a 35% of not meeting it, but we are selecting the stock which has at least 8% gap in terms of that probability range. So that way, and it has a speed of the movement also. So if once tomorrow after the ILO is released, you don't need to do all these ones. These are only the back-end knowledge purpose.
Is the risk reward part of that too, or is that something different?
No, risk reward is not there. That's in the trade rule. You have to do it that way. We'll give you the trade rule. I will give you the screen for the trade rule.
Okay. So basically, the ILO, it uses state 8,
Target 3 met.
then target 3, using the Bollinger Band, and now it's using the ATR.
That's correct. And it's using the reversal model also. Yeah, there are 4 models where you can say the price is lower.
What is your favorite?
My favorite is the Bollinger Band. My favorite is the second one, like the state target 3 met and the Bollinger Band. Now it has 2 channels. There is a statistical calculation value. Now there is a volatility also play coming in, reversion to mean. And a lot of institutions are looking at Bollinger Band, and a lot of these quantitative models are built based on the regular indicators, right? State modeling is ours. None of the quantitative modeling has it. But the other indicator has it, right? So always combining one indicator with the state modeling. That's how the studies are all designed using the regular indicators, but a combination of a state model. If you use regular indicator like this, and if you don't use state modeling, you won't be successful at all. That's one of the reasons why people teach and they don't know state modeling. They don't have confidence in it. Only people who have confidence is like you practice and you see it every day over a period of time, and you see it for yourself. That's the only way of doing it, right? That's how you build confidence in it, because we are not exposing. Like, I mean, people who would want teachers and all, like they would want me to spill out the secret of the state modeling. I mean, it took me about 2.5 years to build it. And at this point, frankly, I also forgot. Like, I need to look in the system to tell you that one. At this point. Yeah. And I mean, all our programmers also, like, now we have to refresh ourselves. Like, we are at a point like where we are saying, like, study this, what we did, what logic did we use. Tomorrow we'll talk about it. That's the state we reached, because it has become so massive and so big. And we built it about 3 years back or 2 years back, and we didn't touch it, and we did a lot of stuff in between. So our minds are haywire. Like, so any logic we touch now, yeah, we are refreshing ourselves, and then we are starting the enhancements. Otherwise, we are not even remembering like the stuff like. Okay, so this, yeah. So these 2 presentations you'll get it, but we'll also look at let me close all of them once, and then I will show what I'm talking about. Let's say like let's go to the current market. See, we want to do, let's say Microsoft. Let's pretend Microsoft we want to buy. Married put. For whatever reason, today is not a right day to buy the Microsoft, but let's pretend like we want to buy the married put. MSFT. Okay, the portfolio risk is raised actually. Yeah, net delta is out of the money. Okay, now let's modify a little bit. In the money, 180, and then like display 5 chances. Okay, so here the stock costs us $184.71. Okay, so today is February. We are giving about 9 months. I mean, around 7 months time. Up until September for ours to be right, and we are also buying. System is telling to buy like a 185 strike with a net delta of $54. For every dollar Microsoft goes up, we make how much? How many cents? 54 cents. And the net risk is $1,351. So 1.3%, slightly higher than our best practice of 1%, right? This is what happens like as the stock price keeps raising, and once it crosses getting nearer to the $200 range, you have to risk about 1.5. By experience, I'm telling you, on a good stocks. And if Tesla is there, then you would, or Netflix is there, you will have to risk around 2.5 to 3%. Because these are so-called option traders, they know what's happening in the market in the stocks. So it's already built in. The price is already built in. So somehow they know exactly what the risk is going to be. So they're going to price the options higher. When the risk is higher, they raise the price of the options higher. Okay. Now let's say like I would want to buy 200 shares, not 100 shares. So first time I would buy 100 shares regularly. Let's do one thing. Why don't we do this not today, but let's go back to the 2019 January, 1 year back, February 12th or something. Let's do the same thing. This way I can show you live. Yeah, it's $100. The risk was $777. Okay. So yeah, let's do this. You see how the risk is also changing? I mean, the risk changes with volatility and the current price of the stock also. When the Microsoft was $100, we were able to risk buy 100 shares, risk only $800. Of the same 100,000 portfolio, less than 1% risk, I'm able to buy Microsoft. But it's become $180. Now I have to risk about 1.3 or 1.4%. As the stock price increases, the risk also, the percentage also increases. That's why I wouldn't trade like after $200. I wouldn't worry much. Like very rarely, I'm still interested in the married puts because it will go beyond the 2% best practices. Very, very rare. That's how I bought Netflix. I mean, at 330, I think. I bought it 330. I should have bought it at 283. Netflix. So yeah. So here I'm buying this in. Let's do the. Okay, I placed it in my paper trading portfolio on 2/12/2019. At the same time, let me get rid of these. Okay. Oh. Okay, so here I would want to buy 200 shares, but I only bought 100 shares now, right? So instead of buying 100 shares more, what I will do is I will buy I'll do a naked put. Naked put of, at least around, we are in February, at least 2 months, about $100. So here what I'm doing,
You buying the naked put?
no, I'm selling the naked put. Yeah, selling the naked put. It's not allowing me because of this shell portfolio. See, in the paper trading account, we say allow exceed amount, allow exceed risk amount. We say no, then it wouldn't open the position, but it should give a message actually. So now I change that. So what I'm saying is, if the Microsoft drops below $100, before April, on April 18th, I will buy stock at $100 minus whatever price I get. So I'm getting $1.50 there. So I'm going to buy.
That's an at-the-money put.
No, that's $100. The stock is around 106 on that day.
106, okay.
Yeah, we could do at the money 105 also. We will get $3. So essentially, we are saying like, okay, if the stock is below $105, I need to take possession of the stock. I need to buy the stock at $105. Yeah, but I'm getting the stock for $103, right? Cheap. So, okay, this is what I would do. At the same time, why is it not creating that? Hello, exceed. There's a problem in the screen, I think. Oh no, current risk percent is allocated. Oh, okay. What is allocated risk?
Why are you in the oil married put?
No, that's just a name.
Oh.
Oil married put is a name. Instead of creating one more,
You're gonna sell a covered call at the same time?
no.
You're looking to just get it assigned?
Yeah, that's correct. I mean, but many times what will happen is it won't. I mean, if the stock moves up, if I buy it at the right time where the stock is going to go up, I mean, we bought a married put and where we are risking this $777, right? So yeah, I'm selling the put for $300, assuming the stock will go up, right? So if the stock does what I think it's going to do, then the $300 married put, the naked put what I sold will come down, lose value. When it comes to $1, I close it. So what would be my net risk there? I mean, together, I'm doing it on the same day. I want to buy 200 stocks, but I bought only 100 stocks. So from 777, I'm going to reduce another $200 risk, right? That's what I generally do. But I do it not on the day of the opening. Let's say like let's do that. Like I will tell you what day I will buy also. So let's move forward.
You just
That's correct. That's correct. I'm reducing more risk, additional premium. I'm taking on more risk for a certain short amount of period, but I would not do on the oil stocks, or I will only do on a high potential Microsoft or Apple or Facebook on the technology sector mainly, because it varies more, and also the when it moves, also it has much more speed. Also, I would want like to close the naked put as fast as possible.
That's your own style.
Huh?
That's your own style.
Yeah, that's correct. That I will do like, let's say in April we go here, and now we have a gain here, 950. This is when I would do that. Yeah, I mean I would say add position. Now the stock, this stock, Microsoft on that day. Let's see like what happened on that one.
Great, that you would have gotten out at 100%.
Right, 123. But I mean on the technology sector, on very high potential stocks, I generally don't exit right away in my style of trading. So if your introduction starting point of it, like, yeah, I mean, this is the best point to come out, because 100% profit you would have got it and exit. That's a easy role. What I do is I do like see, I already have that. I already have the other 110 put losing money, right? Now I'm selling like a 110 or a 115 naked put. I'm collecting more premium. At the same time, the stock went to 123. So if I may pull that one, what would we look at my net delta? I mean, another class like we can do the adjustments class, like where like once you practice more, then we can go a little over and then talk about this one. If you look at the net delta of this position, let me pull out on April 18. Yeah, the stock is making money. Tell me what is the net delta here? At this point, 76. Because I have a 110 protection at 110. The stock is 123. The put delta is only 23 delta. So from this point on, every dollar of increase in Microsoft, I'm getting 77 cents, 76, 77 cents, right? The moment it goes to 90 cents, that's when I start raising my protections. You got it?
I see. You're doing this for Apple, you're doing this for Apple.
Exactly. So where the stock has a propensity to climb and $100 can become $200 stock, I keep raising the put at every, when this net delta becomes 90, then I say, because higher net delta has a reverse effect also. If the stock starts coming down, then I'm going to lose, for every dollar it comes down, I lose 76 cents as well.
How will you raise? By selling the one you have and buy another?
Yeah, I mean, that is one way of doing it. So instead of selling the last put, I mean, see this put already lost $698, right? It has only $300-400 value there, right? So instead of selling that one, I sell another calendar put. I sell another calendar put, a naked put against the calendar, and then I buy another higher protection put. So I keep doing it. Keep doing it. Yeah. So let's say suddenly the stock falls. I mean, once I buy the put, I never sell it. Most of the times, I layer the calendars. So let's say after becoming 150 and suddenly a news drops up and comes back like 125 or 130, right? Plenty of protection. My puts, lot of puts make money. And even though my stock leg starts losing the profit, the put legs start making money. So the accumulation of puts and the sudden drops will make you more money. It's a scenario of, the Rockefeller. The split of the companies made more money, right? Same thing. But it doesn't, because I'm doing it on strong stocks, I don't see it very often. When occasionally it happens like, the stock dropped about, like a stock like NVIDIA, it can drop about $40. Today, if the earnings is not, the EPS is not met, if there is a negative surprise, it can drop $40. That's what we saw, GNI. So if it drops $40, like there are puts, but I don't have a layered puts. They all expired in February and January. Today I don't have a layered puts in the account. But if I had the layered puts, the timing wise, and if it drops $40, then I wouldn't lose the profit. I capture the profit. So today I did another adjustment. What I did was I have a protection around. Let's see, the market closed. Yeah, see Nvidia. What we did is we have a protection at 235. The stock is 271. It's a huge protection gap, right? If the stock doesn't do and it drops $35, this 10,231 will drop by $3,500. I'm going to lose the money, right? The profit. So that's why I bought this March expiration. I risked another $535, and I'm recovering about $1,465. Half of that money I'm recovering. I did another one. So if I'm wrong, Nvidia doesn't move up or goes $10 up, right? I'm going to lose $200 of this $565. I'm going to lose. But the stock went up $10. You get my point? The stock went up $10. The leg what I have, this put leg and this one combined gives me $700. I'm going to lose $200-300 here. Net I am profit $400. I'm all about risk and protecting the profits. First time risk, after I am right, protecting the profits and keep raising the bar. We can definitely go over these adjustments in a mechanical way, in a rules-based format, but I will develop those rules also so that it becomes very easy for people to follow.
Yeah, I should have known this before.
There is, in stock market,
I did one year, Bollinger was not there. And, went up. Well, I wouldn't have gotten out had I had
merit put, yeah, that's true. Merit put on strong stocks where the fundamentals are good and where there's a company like Apple, Nvidia, like all those technology sector mainly, right? Technology and healthcare, like they're high potential sectors, low risk companies, free cash flow, strong fundamentals. Those companies, you would want about a quarter of your portfolio or 50% of your portfolio to be in merit puts, and 25% in the studies model, which is a short term, get 25, keep accumulating that one. That way your entire portfolio level, risk level is low. The greater advantage is the portfolio risk will be low. No matter what, even if the complete 50% market drops, your portfolio is going to drop maximum of 10%, which is much easier because all our merit put opportunities and all our studies, you get opportunities when the market falls. I don't know if you have noticed or not. When the market falls, down day, there will be more trading opportunities. When the market goes up, there are less opportunities. Correct? So that's our money making opportunity. So if the market falls, it's good for newer opportunities, but at the same time, we should not lose money when the market falls. At the same time, once your portfolio goes up to about 10% risk at a portfolio level, meaning if you have $500,000, if the total risk is net risk is $50,000, I would open the index and ETF options as a hedge. So I would hedge about half of it as a hedge. So you would have to have around $1,000 to $3,000 protection cost for it. If you are wrong, you lose the $3,000. But if you are right on the hedge, you recover the 5% of the 10% lost immediately. So you are net only about 5% loss. Otherwise, if the portfolio keeps continue doing, your hedge is only 3% of your portfolio, or less than 3% of the entire $50,000. So you're going to lose $1,500, but your portfolio is making money. So net is like end of the day, if you look at each position by position, you'll be worried about, I lost money. If you look at the overall portfolio level, you're not losing money. You're structuring it.
You have to spend money to make money.
Exactly. Yeah. So, I mean, in this case, right? I mean, see, in this case, I don't want to lose any more money. Then I can say like, I can click on the hedge here. At this time, I mean, on April, I want to protect the profit. Here I have choices. I mean, I can either raise the put, buy that 125 married put, again hedge that 473, or I can buy an XLK put also. These are all the ETF hedges that are there. So you can do the hedging model after once you are right first time, in the first month, you get your money and you still think the stock is going to go up, you buy these ETF hedges which are low cost hedges. Got it? And Delphine is calculating how many contracts you need to buy also based on the dollar amount. Yeah, these are all ETFs. This XLK is ETF, QQQ is ETFs. Yeah, yeah. In virtual portfolio, we have a model to calculate this. I mean, what is the risk level and what is the level of protection you get for each ETF. So here, all I need to do is buy XLK, this one, whichever is the highest hedge score other than the 100, because Microsoft itself, right? Of course, it is double the cost, right? This one is half the cost. For $200, you get enough protection. This one you wouldn't, this one is costly. That's why the score is low. So whichever is costly, the score will be lower. There are multiple factors that went into this hedging model. All I need to do is add this position and it will add to the. Yeah. So let's move forward a little bit. Now I have XLK also, right? Let's go and then let's go to June. Oh, probably hedging was done. See here, yeah, we lost. Microsoft kept increasing up. $1,600. Our profit is from $950. We went up to $1,600. Yeah, we lost $13 on that one. Do you mind? But if it went down, XLK will increase in value. Even though Microsoft position came down, this will increase the value, right? Net portfolio. That's what I want you to think on. When you write your trading strategy at an overall portfolio level, this is how you need to think through. Like, so it's not about trading strategies. Don't pay someone $5,000 to learn about a model, and it's not, and invest all your money in them. No, there is nothing in the world like which is not. I mean, nobody is going to give you $1 without risking. That's as easy as it's said. It's only in your ability to construct the hedges and your portfolio right. I mean, this building, it should not fall means there is a process that they follow, right? Otherwise, no matter how it's not easy. I mean, if I say like I need this building in a month, nobody can do in this world, right? There is a process they follow. Like, so there is a reason why they do certain things in a certain way, and it has to be done that way, right? That's a very well engineered one. Same thing in the financial engineering. That's what the institutional traders do. Institutional managers, they have certain processes and risk management procedures in place that they hedge their risks all the time, and then they keep pushing it up. They're not too much worried. Like, I mean, sometimes the stock falls $50, and then on TV they come on happily, and then all the bigger institutional models. And if a $50 drop happens in our portfolio, like on one stock, like we are too much worried. Like our mind is occupied on that one, right? The reason is like we did not construct the portfolio in a right way.
So on those, it's still either you're in the money by one strike or out of the money 2 strikes.
That's it.
Maybe out 90 days or 180.
180. I mean, 180 is typically on the stocks which is fallen, which has that state 8 model, where you have to give a lot more time. On these, usually I give about 4 months or so, at least 120 days. I mean, I wouldn't buy any shorter than that, because any stock needs time to grow. And when we are looking at 100% of the risk amount, it needs a substantial amount of at least 10-15% of the price movement in the stock. So if you are expecting in a month a 10-15 price movement, then that's very difficult. The other scenario has much higher chances because it's a rebound model. It's a growth model, and the stock is already grown, and it still has to grow another 10%. Like it's like Apple. Apple is grown like unstoppable like that, right? If you expect another 10% by today, then that's difficult. Once a pullback happens, then you buy Apple. Like so.
The one time you mentioned, what is it, two earnings reports or something?
Yeah, at least 2 earnings reports. That's how I time it. Sometimes it could be 4 months, sometimes it could be 5 months. Because based on the timing when you buy, like NVIDIA today, if I buy 4 months, it will cover today earnings or next earnings also, right? Like that. At least my ballpark is at least 2 earnings will keep you at least 4 months time frame. It will give you that based on the expiration, what day you are buying, right? That's a rule of thumb. 2 earnings periods you need to cover using a merit put. Then you have much higher chances to make money next. Any other questions? Exhausted? Yeah. Okay, no issues. So which industry do you want? I mean, next one. What is your choice? I mean, it's a
About the tech?
IPO. I can do it in April. IPO.
What about things with electric, rare earth,
Which one?
rare earth, whatever that sector is in?
What stock is it?
Yeah, like, you know, all the batteries are made for all these Teslas and all
That's the anti-energy thing.
that.
Anti-oil, I'll put it that way.
You want that?
I'd say semiconductor. I look at that.
Semiconductors. Okay, we'll do the semiconductors and we'll cover that. That's also same thing actually. But even in the energy also, there is a First Solar. There is a interesting stocks like where that renewable energies are there, right? That's the little bit of touch of energy, but the technology semiconductors, and it will cover the Tesla batteries and everywhere else. Like
Telecom or 5G.
telecom stocks are not that great. Like so, it's not that great, but we can cover that. Like, yeah.
So next month is what, Ashok?
Next month is semiconductors.
And then April is what?
IPO.
IPO, okay.
Buying IPOs and what is the right time to buy, analyzing them, and
NVIDIA just hit 290.
that's good.
No, because I was talking to Ashok, and right now I would be, it's up too high. It would have been past my expected move. It would have been right at my expected move.
Right.
And the net would have.
Yeah, it was of too less of an expected move.
Unless it drops down, you know, after.
I mean, even if it drops, it will drop around $10. Like so, I don't think it will drop that high.
Yeah, anyway, interesting.
Yeah, that's good. So today we not only gained knowledge, we saved money, Jean.
Well, I have to start doing this.
Yeah. Okay, thanks a lot. Yeah.
Yes. I forgot to ask one question.
Yeah.
We can use married puts in the retirement account, right?
We can.
We can do.
Yeah. Ganesh,
No, no, no.